Good morning. It's the 7th of September. And today on the International Arbitrage, we're going to discuss a little bit about captive insurance companies. Now, captive insurance has been around for a very long time, since the 40s or 50s. Many Fortune 500 companies have captive insurance. So, what is captive insurance? Really, what it is it's like having your own insurance company. Now, of course, as you can imagine, it's not easy to just replicate um, an insurance company because insurance companies are large. But the truth is that this is actually very possible. You can set up your own insurance company. Many um, companies actually do this. Large companies do it. Medium-sized companies do it. And what the situation now today is that even companies that are not multinational companies are, finding it. The economics, the cost-benefit analysis is very much in favor of setting up a captive insurance company. But as I've spent the last year or so talking to a lot of people in my sort of space. So as you know, here in the international arbitrage, we talk to owner managers, SMBs, international SMBs, international family-owned businesses that are closely held, which means they have one, two, maybe three owners. But they're doing international business. Their customers, investors, and operations are in different countries, and they typically are either fundraising or doing less than $100 million. There's lots of these types of companies in Latin America and various countries in Africa, and as we've said also in other videos here on the international arbitrage, just because you live in a country which is devaluing its currency, has high taxes and political instability, that doesn't make your country a bad place to be from a business point of view. At the end of the day, there's bureaucracy in all countries, but in capitalism, high risk means high return. So if you can figure out how to operate from your country, there probably are opportunities in your country which can be addressed, and the risk, but there is significant risk that has to be dealt with. So I'm going to focus on captive insurance companies in the context of mining companies or mining companies or small oil and gas companies in, say, countries outside of the U.S. and Latin America, in Africa, that want to raise capital from, say, U.S. investors or Canadian investors. This is, the majority of my clients are doing this kind of thing over the last 2 years. And so with, the idea of a captive insurance company is actually very attractive, because if if you're raising capital from U.S. investors view small family-owned businesses, closely held businesses that are owned or run under small international private investment funds. So say, for instance, you might have a $50 million oil and gas field, which is small. Large global oil and gas companies, shut down oil and gas fields that cost $50 million. They're too small. These companies have massive overheads, and they don't view it as a good use of their time to operate very small properties like this. And so there are hundreds and thousands of these small properties which are run by very capable families and engineers and operators, and they do very well with these companies. But banks don't want to, if you try to raise $50 million from a bank in Latin America or Africa, A lot of banks don't want to get out of bed for $50 million, $30 million because there's just not enough fees and profit in it for them because they have large overheads. Again, they prefer to spend their time doing the same amount of activity on $300-400 million deal. So therefore, international owners and people, and I'm sorry, I'm just giving all this background because international business people doing mining, small mines, oil and gas fields, raising money now from less than $100 million, say $40 million from U.S. investors. U.S. investors, their advisors, and the private banks that U.S. investors have their money in view small projects like this as extremely high risk. They view it as a lot of compliance risk. Compliance risk can be addressed by by using a regulated international private investment fund with a regulated fund manager. The other thing that they view is, in addition to the compliance risk, they see a significant potential for fraud. And then the other thing is that if there's any debt financing needed or anything else like that, there is basically the problem of the potential for fraud. And then the international risk is, U.S. investors look at the fact that, they're putting their capital, into another country, a jurisdiction that's not the U.S. And the question is, how long before we begin to get our money and our profit and our capital back. And so a small owner-managed business using an international private investment fund has to think about these things. And so one of the things you can do is use a captive insurance company. Now, a captive insurance company there are ways of setting up legitimate captive insurance companies, which are regulated, properly licensed, properly effective day one. So say, for instance, AM Best or credit ratings are really important for captive insurance companies. So, your business, your investors might want to see an insurance company that is AM Best rated issuing, the insurance to the company. And the company will, so basically your company sets up a captive insurance company and then you pay an insurance premium to your captive insurance company. But in the beginning, you're not going to get an AM Best or credit rating immediately because basically you've just started. You don't have a lot of accumulated reserves and financials and financial history. You need to wait a year or two for that. So in the immediate term, what you can do is you can use either, you can use an existing carrier fronting company that does have an AM Best rating, and you can contract with them. So the fronting company would issue the insurance policy to your company, but your captive insurance company would basically receive or enter into an insurance contract with the fronting company, and the fronting company would just take a portion of that insurance premium as a fee for doing the fronting. So I'm sorry to use all these terms. These terms, to find out what a fronting insurance company is, it kind of is exactly what it sounds like, a company which you which you use in the beginning when you don't have an AM Best rating. So that's one way of getting started in the captive insurance company. In today's environment where the U.S. risk-free rate is basically roughly about 7%, the cost of money is accelerated. That's hitting the bottom line of NPV, net present value, financial projections, forecast returns to investors, return on investment, IRR, all these things. Having your own captive insurance company can basically reduce the cost of insurance and actually turn into a profit center. Remember, when you're using your own captive insurance company, there are two key things that we can say about captive insurance. One, is that your captive insurance company doesn't have thousands of employees, massive office buildings, massive marketing and overheads. And so therefore there's massive cost savings, which means therefore that your cost of insurance is actually a lot less. And then also when you have your own insurance policy, instead of having a wide-ranging policy that large commercial carriers issue, which may, you may be paying insurance for risks that really aren't relevant to your company or that you don't need or want to cover. But when you have your own insurance company, you can basically tailor your insurance policy to the specific risks that are relevant to your business. Again, saving costs, reducing insurance premiums. And the third thing about captive insurance companies, instead of paying away insurance premiums every year to a company that you don't own as an expense and never seeing or benefiting from, those funds again, when you pay insurance premiums into your own insurance company, if there are no claims, your insurance company accumulates those premiums and earns investment income on those premiums, which create profits. So a captive insurance company can be very useful for international private investment funds that have U.S. investors and projects going on in other countries. I'll expand more on this in a second video. Cheers.